Morning everyone, welcome to the room. As you know, trading futures involves risk. It's not suitable for all investors. The information in the presentation is for educational purposes, not a trade signal service, not intended to be financial advice. Nice little run up in the overnight, as depicted here on the ES on the right. We're going to have a gap up this morning. In yesterday's close is a 26.81 and a quarter. So if we are to come down and fill the gap, that's a little ways below us. I'll draw up the next overnight low to high. That's at about 94, so there's definitely some room below us if we do start to kind of pull a Friday gap up and sell off. But now if we look at the 30-minute, you can see that short 26.79s, but also the long below is 26.45 and a quarters. And the gap up being right at the negative 23% target of the long. So if we zoom in here, we can see just from yesterday's trading hours only low to high, we pulled back in the afternoon. Trading hours only pullback to the 50%, and then we're now above that move. I'm going to get rid of that drawing. We could draw from lows of the afternoon to highs. That again puts us kind of at the top of yesterday's range, but I'm going to leave that off for now unless we really start selling off. So I'll just make a mental note, 26.87s. Now we're not terribly far from the 61.8 of the short. That was kind of that big level that would need to break in order for us to really get some confirm the upside momentum. But if we draw from lows of Friday to highs, that would give us the next 50% long, which does put us outside of the 61.8. 26.72s is that long setup. So I'll leave those off for now until if we do start to pull back here. But in the meantime, we can kind of see this daily short. Now the gap up, this high back here at 98 and a quarter that I've been talking about this morning, we traded a 98.75s, and that is trading hours only. So we went to a 99.50s in the overnight and still printed above. So as soon as we printed above this high, there was selling. So we'll see if this initial, what's been happening lately is the first 15, 20 minutes have been trading in one direction, and then we kind of get a change in trend and we head back in the other direction. So we'll see if this next long holds. This is just a continuation from, we had the overnight initial run up, pulled back to its 50, and then now the next bounce. Moved to the negative 23% target, now pulling back to the 50%. Come on here. From the VIX side of things, we are getting that sell-off, but still haven't seen quite the bounce in ES. So I would expect that to follow now that we've broken down below this trend line, and continuing in the VIX is continuing to show decline. I would expect that to follow in the S&P here. Even though volume's a little bit lower, there's some good upward trending, and if for some reason we have some news announcement or we do get a spike to the upside in the VIX, and we just go back above the trend line and break the swing high, then I would look for the S&P to follow to the downside. And that's definitely a possibility to have some of these. The trend looks really good. The market's looking promising to break out, and then kind of get a curveball, and especially as we go into earnings here, and the markets could see another slide lower. But earnings is a good opportunity. People are maybe still a little bit on the skittish side with the tariffs and with other things that have been in the media. So this is a good opportunity for the markets or the companies to show signs of strength and put some confidence back in the markets, or instill more confidence in traders. First 5-minute candle is about 5 points. It's pretty good size candle. Break of its low. Now you can draw up just the very next daily retracement from yesterday's low to high. That's in 2687.75, 2688s. I haven't been getting too aggressive with the first 5-minute candle because of the fact that we've been a lot of the times trading in one direction for 15-20 minutes and then going in the other direction when volatility was, well, I shouldn't say when volatility was low, but last year what was happening a lot, and in years prior, is we would break above or below the first 5-minute candle, and then we would continue to trend in that direction. And we could start to be seeing a shift in that to where we are getting more follow through in the direction that the first 5-minute candle breaks. So, for instance, this morning we broke the first 5-minute candle's low, and I would want to see more downside such that if you got short below the first 5-minute candle's low, you could then trail the next, at least few candles for, anywhere from a couple of points to getting in a big trend for the day. In 2017, we had a lot of gap and go days. I mean, not necessarily even gap days, just days where we would open up and we would go from the open. And there wasn't always an opportunity on days like that to get in on a pullback. So what you're able to do is just get long above the first 5-minute bar if we moved up, or get short below the first 5-minute bar if we moved down, and then just trail your stop. And that worked very well. Looks like housing starts were good this morning for March. seems a little bit surprising. It's because well, I guess it's not that surprising. It definitely feels like it's a kind of a seller's market in a lot of these hot areas. Colorado, down here in Arizona, there's just not a ton of inventory. There's not a ton of houses coming on the market. And so prices are definitely pushed up, and I know people in Colorado are, they're offering a lot more than the asking price, and you've got a couple of 2, 3, 4 offers coming in at once. And stuff down here in Phoenix, Scottsdale is going quick. Here's a good example where that reversal kind of that I'm talking about, where the market moved initially down off the first 5 minute and then bounced back up. Not really a long continuation. I got NQ pretty solid uptrend continuing through its overnight. The YM also similar. Gamma. The YM similar, kind of forming a bull flag, and then if we compare that to the ES, a little bit more of a pullback, but still, for the most part, trending within its overnight trend. I do need to get caught up on last week's, finish up with the putting together last week's market profile. Spent the weekend in the Arctic tundra of Milwaukee, and boy, did we get some nasty weather. Can't say that it totally surprises me, but had it been January, wouldn't be so bad. But for middle of April, it wasn't too pleasant. And for those in Chicago, we flew out of O'Hare, but and it wasn't too terrible, cold and rainy, but boy, not the most pleasant of times to go back to the Midwest. But It'll turn around. I will be back for the Traders Expo here this July in it's going to be in Chicago. So again, yesterday's close, we have an 81.25. Not at this point very close, and I leave up the retracement here, which, you know, in 87s, if we were to come down, we've got support at the previous high, yesterday's high, and then the close. So again, don't really necessarily even need that on right now. Breadth and advanced decline line looking good. You know, last week we saw a similar situation where we get these high prints right at the morning, and then we round down or slowly drift down towards the zero line and then flatten out and move more horizontally. So you can kind of disregard the first couple of prints if you want to get some relative highs and lows. So we've got the NQ making new highs, as Nicholas pointed out. YM, not quite, more of still flagging. Nice little channel though. And then the ES, very close, more of a cup rounding out formation, but holding this second retracement. So when I start the day, I'll look at the overnight, see if there's any patterns or trends forming. We had the first pullback in the overnight that traded right to its negative 23% target. So then when I draw the second from that entry to highs, seeing that it pulls back, I would expect that we move up here to the target, and that is a 2702s, 2700s being kind of a big round number. So that's a good thing. We're definitely at a inflection point, as I was talking about in last week's video, or yesterday's video rather. So it's a good time to be present in the markets. You know, getting up above this high back here on the 22nd of March, that gives us room to put in some bigger body candles to the upside, get some trending activity, because we are then now out of the consolidation. Consolidation is important to create the support and resistance areas for us to bounce off of or knock our heads against. And you can come back here and say, okay, well, 2700, 2725s maybe was kind of a point where we traded above and below for about a week. But even if we roll over and move to the downside here, even if the 61.8 holds, there's also room below us to come sort of crashing down or roll over quickly and move quickly. So that's kind of the dynamic we want. Quicker movement with more follow through. So not just kind of a little up move and a little down move. If we can get bigger swings with more follow through. So when the momentum changes here, whether we either push higher or sell off, if we can get that follow through and more traders jumping on, then we start to develop more of those big body candle trend days and bigger swings intraday that we can then play off of. The ES close to breaking its overnight high. I'm going to leave the retracement drawn up that I have and then turn off the overnight so we can see what just the trading hours only looks like. About a quarter point away from the overnight high. It's helpful to see, where we went in the overnight, but it's more important to print that price in the trading hours only time frame when the NYSE is open. There's just a lot more traders present, bigger positions, so there's a lot more weight when a number prints during trading hours. So if we wanted to draw what would be the first trading hours only long, I wouldn't take this necessarily as a blind limit. That the pattern has been to fail that first trading hours only long, but letting it trade or letting the market come down to a level and identify that there's some sort of bounce or participation there from traders, and then coming in here and taking the very first or the very next setup on the 512 off of that bigger support level or bigger resistance level is a good way to kind of ease into the day. If we had shown a pattern of lots of traders buying the first trading hours only, then it'd be a trade that I'd be more confident in taking as a blind limit, but that has not been the pattern as of late. So now trading at the trading hours only long and also holding the overnight long, we'll see if there's any reaction. And once the market starts to show signs of, a first 5-minute candle, for example, once that pattern starts to resume to where we break the first 5-minute candle and trade in that direction with lots of follow through, or trade at the trading hours only, the very first trading hours only setup, and then get follow through, then we can continue to start jumping on those setups, or a market like the 6E has been, it kind of comes and goes in the last year or two. It's good for a little while, and then it kind of isn't so good. Those kind of patterns are things that you just kind of develop a rhythm by watching them. And the more you watch one or two markets, the more easily you can identify when some of those patterns are coming and going. We can draw up the NASDAQ's trading hours only, and it's definitely a little stronger, a lot stronger. Hasn't come down all the way to its 50% yet. So if we start seeing signs that the market's going to hold its very first trading hours only setup, then we can start looking to trade those. So after a setup trades, I always draw up the opposing. So when a long trades, I draw up the short, just to make sure we don't stop right at it. And if we break through the 61.8, then we break the little swing high, then we can draw up what would be the next setup, or the very first setup, and see if we can get some traction. We haven't broken out yet, so this is more of a anticipatory trade just prior to the breakout. 97.25, 97.50s, rounding up and adding a tick, and the market has already gapped up, so it's possible you can gap and go. Meaning you gap up and continue in that direction, or gap down and continue in that direction. You can gap and crap, which is would be a gap up and then sell off back down to the gap fill. And then there's the kind of a gap and move sideways, which I guess you could call that the gap and crap, where you just gap up and then just move sideways. The gap failure would be more of a gap up and then a sell off. So touched 50s, touched 97.50s, didn't trade through it. The overnight is 50% below us that I had drawn up. Its target is up at 2702s. We're just shy of 2700s. And we got to 99.25. A lot of these stocks are starting to trend similarly, getting sort of this ascending wedge pattern. Netflix a lot stronger than some of the other tech stocks. Same thing with Apple, kind of a triangle that is trending upwards. So not quite the channel, because it's getting tighter and tighter. And so not quite just a channel that is moving in the same width throughout the hole. So we're trading, we've formed a wider initial base and then we've gotten tighter, and I would look for some sort of resolve in the next, either whether it's today with a big body candle or tomorrow. Got close again. I'm watching this high, a 99. So we traded at the 99.50 overnight. We traded a 99.25, and then right now we traded a 99. I really should have moved my anchor to this high, but it doesn't really matter. That same 97.50 trades either way. If I drag this up, becomes a 75. So either way, 97.50s or 97.75s, it's all the same. One tick should not make or break the entry. So now that we've broken, not necessarily just broken the high, but always using the negative 23% target for so when you have a small setup like this guy here, the 97.50s or 75s, that follows a larger setup, I'm going to delete this real quick. I like to use the negative 23 here at the larger one. So set my target at 700 and then just round down and add a tick. So 2750s is my first target. So rather than using the target on the smaller, so I use the smaller long here, the first setup after the larger trading hours only. I let that come down, let the market come down and show that there's participation. Okay, great. Traded nice and cleanly. We got a bounce. I drew the opposing short. I want to see that we don't just bounce, stop at the short, and then sell off. Then I draw up the first setup after the bigger one. In this case, it's the trading hours only long. And then I still use that negative 23 as my target. And you can just kind of look at it here. You've got a 97.50s up to about a 99.50s. So it's still 2 points, but the larger target is not very far above us, even so. So a 750 for my first. So if you've got two contracts, you can really start doing a lot with trade management. If you got one contract, it's very, very good practice and good habits to take it off at the negative 23. As hard as it is to let the trade continue on and be sitting on the sidelines, you can do pretty well taking 10 ticks, 12 ticks, all day long. But when you get to two contracts, now you really get the benefits of being able to scale out by taking one off at the negative 23. So now I've got my stop up below the entry candle's low. So that's a 96.75s. And all I'm doing is just moving it from -6 up underneath the next swing low. Now that we've pulled back a little bit, if we can return to new highs, then I would just move my stop from underneath this swing low up underneath, whatever the swing low is up here. But we first have to break out. So starting with -6 on the ES as my stop. And if you've got two contracts, when you take one off at the negative 23 and you're tightening your stop, now you're reducing your risk on the trade because you've took profit on half the position. If you've got four contracts, you just double. Take two off at the negative 23. Move your stop up after we break the swing high. move your stop up. That's the first step. Then when we hit the negative 23% target, you throw your order out there before you even get there. Take one contract off there. And now you've got this second contract sitting there. You've locked in profit and reduced your risk. So now you've got some flexibility, and this is where you can really you can get that home run sometimes. If the market just falls back down here, then you've already taken profit on half the position. You've reduced your risk on the trade, and you can get away with a small to moderate winner. If we continue, now you're already in the trade. You don't have to put on new risk. I'll draw up this next retracement here. You don't have to take on new risk by putting a new order on it at 26.99 and a quarters. We've got kind of two potential trades here. We've got the next smaller 512, but then we have the larger, the full halfway back from the larger one, low to highs. And you can kind of just split the difference if you're not sure. Just draw up both of them and say, okay, we got a 99 and a quarter, we've got a 98.50s, and so maybe we just put our order at 98.75s. If you're not in a position, but having a position put on lower and then scaling out on the way up at a reasonable level, not scaling out at one tick, or putting on 10 contracts and taking 8 off for a point. The idea is that we get in a trade and then we're able to reduce our risk with a portion of the position, but then you want to have a bulk of the position, 50%, and if you've got 2 contracts, you can do that by still only taking 1 off. So right now the market coming back down, feeling that 2,700 pressure. I suppose, like I talked about last week, we need a new word other than feel. Intuition, observation. Market has ticked up here. We opened up at a high, sold off a little bit, put the low in for the day thus far. Then we broke the high by a tick and then got some selling. Then we broke the high again by, almost 2 points. Got a little bit of selling, but the selling is decreasing on the way up, and the break into new highs is increasing. So that's a positive sign. Another benefit of having a position on and not having to try and get in a new position every single time. If you got one contract, you're kind of stuck with that unless you opt to just trail and say, okay, I'm gonna let the market come up and then wait for it to pull back and wait for it to make a new high and then just keep tightening my stop. And some of the trades are going to come down. I might have had 2 points profit and it might disappear, but other trades will get that runner, and you'll be able to take away a bigger gain. When we come down like this, kind of retest highs, and then I guess retest the entry first, and then we've retested at highs, 2701s. A double top is an opportunity to tighten your stop. Right now, I've got it at 96.75s. If we move it up here to 97 and a quarter, it's only a couple ticks. It's not really a huge change, but when you do get a double top, that is an opportunity to tighten a little bit more. So if it, you kind of have to ask yourself, are you comfortable risking those what is it, 97.25 versus 98.75. Are you comfortable risking 2 ticks by leaving your stop back here to potentially make another 2, 4, 6 points? And a lot of times for me the answer is yeah. What's 2 ticks? If the market wants to come down and retest the 3rd time, maybe having my stop a little lower, just below the 60.18 here, would keep me in the trade. But 2,700 being a pretty big round, big solid number with the gap up. So it may take a couple of tries here before we really break through, punch through 2,700 and stay above it. But we've got a lot of signs below us, or a lot of momentum below us, with these retracements that have upward momentum, these longs below us. So what I'm going to do, I'll leave up the initial setup here. And the overnight 94s, its target is at that 2702. I'll leave that one up just so we can kind of clean up our chart. And then we'll see what we get here. If the double top ends up being a topping formation that holds and we break the low, the swing low, then we may get an opportunity for a nice short. Full trading hours only is at 97s, which puts us just below the 61/8 of the entry long. So I'm just going to keep my eye on that one for now. Yeah, we did have a low tick down here. Doesn't really correspond with too much other than this dip. So it's always good to be buying on low ticks and selling on high ticks, even if they're just relative like this. But no high ticket high or low ticket low that would define a top or a bottom potential. We can see the break above the first 30-minute candle's high. And remember last week, breaking out here. Side note, so now that we've broken out of highs, broken more importantly this swing high, now is an opportunity to move your stop up underneath this candle's low, so a 98.50. And it looks like there's some quick selling that that may push below that, but that's where it's at, 98.50s. But last week when we were chopping around a lot, we would see a lot of time spent within the first 30-minute range. Not that we can't go back down there. What I'll do is just draw a horizontal line. Where are we at here? Yeah, I guess, say 99.25. So there's our break. So first 30-minute high I've got marked, and as long as if we come down and just trade within the first 30-minute range, that's a sign of weakness. If we can stay above it, sign of weakness and chop. You notice the quick thrust down, kind of breaking the swing low, getting taken out of the long trade. It may be enough to shake some people out and then reverse here and go back into new highs. But again, notice how we double topped and we only moved into highs again by 2 ticks, and then an immediate push down. Not saying that it's the top, but there's definitely still selling pressure, even though we've had some nice upward momentum here. Nothing really on the ticks other than a few, plus 600s up here on each of these thrusts higher. So these high ticks, relative high ticks, corresponding with these high prices here in the morning. But it's helpful to know where the first 30-minute range high and low is, because if we trade within that, that's a very choppy place to be. If all we do is form a range in the first 30 minutes and stay inside that, it can be a tough environment to trade. Here we did get a little short setup. I'm going to draw this up. Kind of happened really quick. So as we broke the swing low, we bounced, traded at the 50% short, and are now moving towards the downside. So it's at this point that I'll come draw the full retracement, trading hours only, lows to highs, and we'll see if we get a bounce at 26.97. Again, I'm not going to take a blind limit order here. I'm not going to have a resting order sitting here. But if we get a bounce, then we can look at taking a long off of that level. The first trading hours only did hold today, a nice clean bounce at its 50, so we may get that again. I wasn't quick enough to get in the short here, but I'm going to leave that up too. Short at short near highs at the top of the first 30-minute range, a good setup. And when I say so, the short just defined by the break of this swing low, that is where I had my stop placed. We have a high, market came down, broke the swing low, and then bounced up into the short. NQ, very, very strong. And then the YM, I would say the NQ is the strongest, as Nicholas pointed out. And then the YM sort of moving sideways. And then the ES getting more dynamic. First the pullback, then the rallied new highs, and then now another pullback here. But some decent trends throughout the morning so far. Yeah, good question, Daryl. So Daryl asks, if you got two contracts and if you're using a bracket order where you've got two stop orders below you, and then you've got do you put two targets out there? And what I do is I set my brackets for plus 12 and plus 24 if you got two, and then if you do four, it just doubles that. And once my order goes out there, I'll adjust the first contract or the first half of the position to where the negative 23 is. And then I'll typically just get rid of that second contract, so I won't have a target on the second one. I'll still have the stop order in place, but I will get rid of the second half of the contract's target, and then I'll just trail my way up. Yeah, there's definitely a lot of factors, Nicholas, that play into traders' confidence and desire to be either putting on positions or taking profits from positions, especially when people are speaking that are taught when people are speaking about the longer outlook. Longer term factors that might play into the market, but at the same time, a lot of traders are also weighing in on what's going to be the potential short-term move to that long-term effect, and how can they kind of take the opposite or get into a position just short-term that might be a reactionary trade. A lot of times after the FOMC meeting announcement, you see a spike in one direction and then a reversal. Yeah, and that's okay, Daryl. If you've got the idea, so like on that first trade, you get long with two contracts, you take one off at the negative 23% target, or one off at some point, beyond 2 times your risk, 12 ticks, somewhere up in that region. And then the idea is to stay in that second contract as long as possible. Try and trail that second contract so that if we were to trend here this morning, we don't have to keep getting into a new position, putting on new risk, and then working our way up. We can just trail that contract. And sometimes, you put on a position in the first half hour and you end up sitting in it for an hour or more. Sometimes, I've been in positions where I get in on that first 5-minute candle and stay in till the close, or near the close, last hour of the day, just because the market opened and trended, and was able to just trail my way, hang on to the position. And that's really where it's at when it comes to making a sustainable return, or making a decent return on a trade. It doesn't really pay to micromanage the position and take 2 ticks when you did all that work to get into a trade, find the entry, especially with the futures here, where we're getting pretty technical, getting down to the tick, placing our order. You want to be able to hang on as long as possible. And the same thing goes for, getting in on a stock early. The cryptocurrencies, if you just bought it 200 and sold at 400, that's pretty good. But if you bought at 200, sold a tiny bit at 400, at least the amount that in amount to reduce your risk a little bit, and then sold another quarter at 2,000, and then the other quarter at 15,000. Now you've got now that quarter of the position, or that half of the position, has so much more effect and power because it's being multiplied 100 times, 10x, 100x, 500x. And obviously not every trade is going to do that or come close to that, but that's the concept that we're working with. So the more we can think in that way, the better. So we did get a touch here, not quite, close to the 2697's long. You can definitely observe here the candles on the 512, the Heikin-Ashi candles, moving much more, a couple red, couple green, couple red, couple green, much more sideways along this horizontal top of the first 30-minute range. A little bit on top of the range, a little bit on bottom of the range, but over the last 30 minutes, basically moving sideways. It's a little bit messy in here, but we can kind of come in and draw up the long. Even though we didn't touch, came one tick away from the trading hours only long. This is then the first. We bounced, we broke this little swing high, pulled back. And so you're always looking for the first little move after the bigger, whether it's a trading hours only setup or a bigger 15-minute setup, when there's not really an established multiple repeated trend. But so as I continue that thought, where I was going with that is we've bounced, but we also stopped at the short. And so that's what kind of puts us in a little predicament of, okay, the short traded first. We moved down, we'll call that to the long. Then we bounced and we stopped at the short again. And so, waiting for a break of the 61.8, drawing the full, opposing, getting rid of this little short. And then coming up and drawing a long is okay. So a 99.25. So basically the top of the first 30-minute range. Again, we've gapped up. We're kind of moving sideways here, but we may probably likely to go into new highs again here this morning. Still have the unfilled target from the overnight above us. And then the trading hours only that is, we could come down and retest trading hours only again, but we are at the top of the first 30-minute range. You can see these opposing tails here showing, kind of right on top of this 2700 area, showing that, there is some indecision. Both sides, bulls and bears, are kind of pushing on each other. You kind of see the little triangle forming. Got the high, the low, lower high, higher low, kind of forming on top of the first 30-minute high. Yep, always using a 6-tick stop, even if volatility increases. I find that as I wouldn't call this a high volatility environment, but when volatility is high, it doesn't necessarily mean that the market is not going to be technical. So what I will do, so if we're in a very strong trending environment and we're trading right at trading hours only at the 50%, and then we bounce, then we'll get another pullback to the next 50%, and we'll bounce to the negative 23. Then we'll pull back to the next 50%, and we'll do that 5, 6, 7, 8 times in a row. We have not seen that since the end of 2017. So then you're taking more what I would call blind limit orders at the 50%. When volatility is higher, or we're a little bit more uncertain, then I'm letting the bigger levels trade and then drawing up the smaller setup on the 512. So I can still get away with the 6 ticks. I just have to be a little bit more patient with my entry. Now here's another move above the previous swing high. So again, that 99, 99 or 99 and a quarter. Moving your stop up doesn't do a whole lot at this point. 97.75s is where it was in the first place. But if we can pull back, form a higher low, and then break the swing high again, or break the actual high, and then that's an opportunity to move up your stop. So always good to the idea is to kind of have a process. So then that target on the trading hours only, 26.97s, is up here at that was a 02. So 27.01.75 is where I put the first target, if you will. So now that has hit, again, you are taking one off if you've got two contracts. There wasn't really an opportunity to tighten our stop, but now you've got market that went 99. Actually, that one was a little higher. So that 27.01.75 was actually the overnight target. I use that instead. So the trading hours only is still a little bit higher. Not a big deal. The idea is that you're putting an order out. You're taking your first contract off, at a so a 175 to a 99 and a quarter, shy of 3 points. I'll take it. Now you've reduced your risk on the trade market. You've got the other contract, market again only going into new highs by a couple of ticks, pulling back, and if we can form a higher low here and break out, then we'll be able to bring our stop up and maybe be able to get in the rhythm of new high, pull back, new high, pull back, and start trailing our stop up. If the market isn't really pulling back or isn't really giving you higher lows, if it's just kind of going straight up and then straight down and retesting every time, you can draw the next retracement and then just use the 60.18 as your line in the sand and move your stop up underneath that low. So if you were pretending that you weren't in a trade at all, you could draw up the next low to high and pretend like, okay, 2750 is the next long, and the failure point is below the 60.18. So if you're in a trade and your stop is anywhere below that 60.18, you can move it up to that, we'll call it 26.99.50s or 99 and a quarters. So that is another good way to kind of methodically trail your stop. But I like to use swing lows and swing highs because they're a little bit more definitive and on the chart. But we've definitely been seeing the market move into new highs and then get a little bit more of a pullback that is breaking a swing low or a couple of swing lows. So we'll see if this low down here holds or if this 99 and a quarter holds. It's all about having a process, having a process to make decisions, process to think through. And actually, the process is what helps us not have to make sporadic decisions that might get influenced by our emotions and how we're feeling. if we can always revert to a process when we're making a decision, you want to go out to eat, there's a good chance that you'll think through your list of places that you've been that you really like, that you've tested yourself. If you're with friends, maybe you'll ask for a recommendation. What's a good place you've been to recently? So a place that they have tested. You might go to Google or Yelp, pull up some reviews to find a place that someone else has tested. But the idea is that you're looking for ways to reduce your risk and ensure a greater chance that the restaurant that you're going to try again or for the first time is good. So that the same thing goes for making decisions in business or in your trading. How can we reduce our risk? Look for things that you've seen happen over and over again and trade them within a process. So here's another double top, same thing we just saw. If you want to bring your stop up to 26.99.75, that would be a good option. That is also below below the low, right about the negative 61.8 or at the 61.8. But when you get a double top like this, especially at highs or lows, it's a good opportunity, a totally valid opportunity to bring your stop up, because the short setup is to double top, to break lows, and then draw up the short setup. So you want to be exiting along at the sort of confirmation of the short start. So yeah, you may get stopped out. We may come down here and retest the 99s and then bounce. But again, you just methodically go through the process. You've already taken, if you've got one contract, you've taken the profit on the position. If you got 2, 4, 8, you've taken half off, and then you're sort of playing with the house's money. The other thing that trail stops do is they allow for the market to tell you when to get out. And if you've been trading with me for a while, you've heard me say that quite a bit. And that does a lot for the psychological aspect. It's easy to get frustrated and close out of a trade, and then, if you've got one contract and you close out, and it runs, you say, oh, well, I wish I would have trailed my stop. And then the next time you trail your stop on the position, and then it goes exactly to the negative 23 and reverses. And you say, well, gosh darn it, the next time I'm going to use an arbitrary target and just get out at the target. And you're just constantly on the opposite side of the trade. Well, with trail stops, you're letting the market dictate when it's time to exit the trade. And so, you never want to focus on, well, I had 5 points on the trade and I got taken out and I only ended up with 4 points. You want to look at it from, I started with 0 and now I'm up 4 points. Don't focus on the peak profit of the trade. And don't you don't want to be sabotaging yourself or kind of going back and kicking yourself because you didn't get out at the tip top or the high or the low. But by using the swing lows to get out, they're very structured levels in the market that you can use to manage your trade, and then that helps manage your emotional state as well. Now a triple top up here. We got this other swing low. I'm just going to leave my stop alone down here, but yeah, Abby, the overnight retracement did hit its target. That's a good point. The low, this 94s to highs, but we also have the trading hours only have 97, that its target is just above us at 03s, it's 2703s. So I'm not going to draw up a retracement just yet, like a full retracement on the day. That low is, I'd wait for us to start breaking some of these swing lows up here. We've kind of got this ascending triangle forming. But if we start breaking these swing lows, then that might be a good place for us to come back to. Or what I prefer to do is use the prior day's like afternoon low to high. See where that puts us. So we'll see if we can break out here. Yeah, good question, Daryl. I had bumped the mute button there. So what I was saying is, when you start going straight up like this, you can start to trail each candle's low. You can put your stop underneath, by a tick or two under each candle's low, and that's a good way to, okay, if you've got your stop down here at 2701s and the market's, 4 points above that, if you get nervous or you don't want to give back that much profit, trailing each candle's low is still a good way. It's a pre-thought out trail stop approach, and it's better than just hitting the flatten button and being scared out of the position down here and then watching it continue on above. So it's a more aggressive trail stop approach, but it's a good way to at least stay in the trade and let the market once again take you out. Now, if you've got like 4 contracts, you could take 2 off at the first negative 23. You could trail the third. If you get a very straight up move like this, you could trail the third by each candle's low, and then you could hang on to that fourth for more conservative trail stop and just trailing the swing lows. To Craig's point about if you're not in a position and you're up at highs like this, and you get a sense of the market has really run from down here at the 99s, the long, for the market to now be up at 2704s, that's, you really have to just ask yourself, do I like the trade up here? Well, I liked it a lot down here. Do I like a long necessarily up here at highs? Maybe if we pulled back a little bit, but not up here. I don't like it because this is the biggest break into new highs that we've had on the day, which is nice, but I would definitely want to wait for a bigger, now that we've come up to the negative 23 of both the trading hours only and the overnight, I would look for or expect a little bit bigger pullback, maybe something down to 2701s. That I would like. Previous highs kind of back in this region, then we may not get that. The market may not come all the way that far back, but it may. Going into the lunch hour or the late morning, it definitely yields more possibility to move sideways or to pull back a little bit deeper. But once again, and just one more reason to where even if you have 2 contracts, to just try and stay in that second one as long as you can. As long as the market's trending in your direction, just hang on, hang on. On another note, if any of you guys use Post-it notes, and then you move to a pad that does not have Post-it stick on the back, gosh, does it make kind of a mess when you got things written down in Post-it notes that aren't sticking to the table. It's such a small little thing, but these non-stick, this one non-stick pad that I have is gotta go. So now again, market has pulled back a little bit, but it needs to break its high before we move the stop up. Otherwise, the market can make 2 legs down and then break out, then you just get taken out. In order to be a swing low, it needs to break highs, or in order to be a swing low that you can put your stop underneath, we need to come back up here and break highs once again. Getting close to that 27.10s, which is the 61/8 of the daily short, that bigger level that should put us in the clear for longs, or even if we come back down, it should kind of free up the bulls to say, okay, we failed the daily short, we are clear for takeoff to be getting in longs. Okay, so here's our break. So now this is really where you know, moving your stop up like this from a 27.01s up underneath a 27, so a 27.0375s. Now you just move your stop almost 4 points. You've taken profit on the trade. You're long from 99s. The market's up here at 27.06s. All with 2 contracts, you know, all with 2, 3, 4 contracts. I mean, it doesn't take a incredibly high number of contracts to really capitalize on the market. So continue to follow that process. Continue to let the market move higher, pull back, move higher again, move your stop up. I mean, this should be a very calm, carefree trade at this point. You've been able to take profit on half the position, trail the second half of the position. Even if you had 2 contracts and you trailed each candle's low back here, and then you got stopped out, I mean, just went 99s to 04s, plus taking 3 points over here. You know, that's 10 points right there. 6 and 3, thereabouts. 8, 9, 10 points. I mean, so yes, getting the 2 contracts is a big step for some folks, but if you can get there, even if it's on sim for a little while, there's a lot that you can do with trade management and exiting the position. So don't be surprised if we make a little bit bigger retracement, but now that, I mean, you can see the top of the first 30-minute range so far below us relative to other days. If you go back to some of the slower Tuesdays that we've had where we've been in the first 30-minute range, it's nice to, when you have a day where you get outside of the first 30-minute range and you can just see the difference. I mean, you can just see the trending that occurs outside of the first 30-minute range as opposed to stuck inside of it. So I'd expect this 27.10 to kind of act as a magnet and pull us higher. Market's already up on the gap and continuing in that direction. So I hope everyone has a great day. As always, you know, feel free to shoot me an email. I enjoy our conversations throughout the week. If you have specific questions or want to chat more, tim@emoneymind.com is how you can reach me. So thanks, everyone. We will talk to you soon.